Hey guys, it's May from Markets with May, and this is the first of a three-part series of how to look at bank earnings season. The market's been really volatile at the start of this year, and that really has to do with the fact that it's going to be earnings season that gives you a sense for exactly what the trajectory of the rest of the year is going to be like. It's always the large mega cap banks that kick earnings season off. Now, while this tutorial will give you the information you need to better understand all the news flow that's coming out on the banks and what I'm looking for, it is also the case that these banks throw off massive amounts of economic information that any investor should care about. Now, I decided to make this three-part series because while it's the case that what the banks tell us is some of the most intelligent, important information each earnings season, because of the nature of the financials, it is particularly hard for most young analysts and investors to understand. An example, I was actually inspired by this video that came out on Yahoo Finance. And although the information is all accurate, I do feel that they weren't able to get a real thesis because they couldn't get their arms around what these companies actually do and the implications thereafter. Still, to be clear, I think the information they gave was great. And with part one and part two of this video series, you'll be able to then, in part three, slot in a lot better how to think about not only the banks, but also other aspects of your investment portfolio. Now, in part one of this series, we're going to talk about what do the banks actually do? How do they make money? In part two, we're going to talk about the types of economic data and inference that can be pulled out of bank earnings season and how to then apply that to your own investment process or macro view. And in part three, I'm going to react to the video and explain to you what I heard so that you can compare it to how you're listening to it and using it for your investment purposes. But before we get into that, past performance is not indicative of future returns. This is not investment advice. This is for education purposes only. I definitely have positions across a broad host of financials, both long and short. Shout out to Gurula.app. Money goes to where it's treated best. You can find out more about them in the show notes. Now let's get into how the financials make money. But what we are going to talk about is that first big wave of banks that comes out. On Friday of this week, Friday the 13th, you're going to have JP Morgan, Bank of America, Citigroup, Wells Fargo, and BlackRock all report earnings. And they're going to come out on Friday the 13th of all things, and then we're going to have a 3-day weekend because Monday is Martin Luther King Jr. holiday and banks are closed. In other words, it might be quite a wild ride for the next 2 weeks or so. Now, one of the biggest challenges for analysts and reporters alike is that in order to understand these big mega cap financials, you do actually have to understand 4 different businesses that exist within them. And then on top of it, a lot of the financial metrics that you might use from a different industry to then think about another industry are turned upside down on their head within the financials. Now, I'm going to go through each of the 4 business lines in this video and then give some comments at the end that might be relevant across all 4. And you want to realize that each bank is going to divide this out in a different format, and not every bank will have all 4 business lines. But roughly speaking, the 4 that I'm going to go through are first, the asset management business, second, the capital markets business, investment banking, and finally, 4, commercial banking. Now, asset management, ironically, makes money on the business of managing assets. While all of the banks that report on Friday have an asset management arm, BlackRock is really the largest standalone asset manager and will be the one that everybody looks to see what's going on throughout the entire industry. Now, asset managers these days make money primarily on what's called fee-based revenue. And fee-based revenue has to do with the total assets they have under management. In other words, if they're able to get more assets to manage, they make more money. And it's always just a percentage of the total assets they manage. But let me break that down for you just a touch. They can make money off of just getting new money to come in. In other words, they go to XYZ pension fund and ask to be the manager of that capital. The pension fund no longer wants to manage that capital in-house because they find it to be expensive to hire analysts, to hire a head of investments, all that stuff. And so they're outsourcing the activity of managing assets to someone else. That's institutional assets being managed externally. So for example, the state of Florida just pulled its money from BlackRock, and essentially they're going to reallocate that to a different asset manager. They may not be managing all of their money just with the resources that the state of Florida has. That would be institutional money. And then for the retail investor, it's just you or me trading or investing in ETFs, index funds, things like that. Alternatively, you might just be of a certain wealth level, and maybe you give your money to Goldman Sachs or Raymond James or something like that. And then the asset manager account rep is going to allocate it to different products, and then they're going to get fees off of that. Now, fee revenue is just going to be how much money you gave them times whatever it is you agreed to for them to charge you to help them out with managing your money. And that's always going to be, largely speaking, a percentage times total assets. So if you go into an ETF and you look at the prospectus or you look in Yahoo Finance, you can see the fees that are being charged. That's going to be what they made off of the fact that you gave them money. Now, some of you might be thinking to yourself, well, wait a second. When I bought the S&P 500 via the SPYs, ticker SPY, I didn't pay any fees. No one asked me for fees outright. Well, yeah, that's probably true. But the way that they get those fees is that there's a dividend payment that's made by all of those companies, and then they take it out of that before they issue you that dividend. So, for example, and with very rough math, the dividend yield on the SPYs, the SPY, is 1.52% currently. The fee that they took out of the dividends is about 0.09%. This implies that probably the actual dividend yield of the S&P 500 is 1.52% plus 0.09%, or about 160 basis points, 1.6% or so. Now, there is a little bit more to it than that, but that's roughly speaking how it's done. Typically, for the asset management business to do exceptionally well, you are going to have to see the markets go up. And this is because new assets raised is typically a number that's significantly smaller than the total assets that they have under management. So if the market goes down, that total assets under management goes down in line with how much the market's changed. However, if the markets go up, the assets under management go up relative to how much the market's changed, and then they charge you a percentage based on that number. The capital markets really has about, I'm going to call it 3 different business lines. The first one really is trading, and trading revenue might be, equities, FIC, which is fixed income, commodities, and currency. The second rough business line, capital markets, and the third area of business is prime brokerage. But trading can sometimes be a little bit misunderstood in how it makes revenue. It definitely needs a more volatile market to make money. However, if the market is too volatile, what will happen is assets will just come out of those markets, and that will just decrease all of the revenue. Now, this is true no matter the asset class, and in fact, all of them are kind of related to each other as a result of that. But we've had so much volatility in the individual names, and then we've had a bit of a rough time of it, that it's hard to kind of get a sense for what the mix will be, whether or not these pieces of the business will end up making money. Well, some of you might be thinking, well, what about like an Archegos loss? Where does that end up showing up? Well, some of it can be on the trading side, but mostly it's going to come from prime brokerage. Prime brokerage is the services that are associated with margining that are over and above just day-to-day trading. It's going to have stuff like stock lending in it. It's going to have stuff like very random instruments that might need a very particular type of margining in it. Prime brokerage does have components of risk that are really hard for a lot of folks to understand, but nonetheless, it is a necessary evil for a functioning market. Now, one of the reasons I said kind of is that if the prime brokerage does something as an extension of credit that can't be offset one way, it will oftentimes show up in the trading revenues as an offset. So that's why you can't fully separate those two businesses. But it will also occasionally show up in the third piece of business that might be in this section I'm calling capital markets. Now, if you work at a bank or a broker-dealer, sometimes you'll be calling it debt capital markets, equity capital markets, but it's the piece that almost looks like investment banking but is facing trading. And the reason it's doing that is because there are a whole set of products that a bank might be creating, both in fixed income and equities, that isn't exactly a banking role where you're looking at companies. So in the simplest of terms, let's say you have an IPO and you hire a broker-dealer to do this activity for you. There will be a set of investment banking revenues, which we'll get to next, but there will also be revenues associated with stock stabilization, a selling fee, a selling concession. And there's going to be this group of people that sits between those two organizations, and that is the revenue source that they're making. Now, I'm going to give you a second example, a little bit less straightforward, but I'm going to try anyway. Third example of what this group of people does might be a really truly large seller of either bonds or stock that needs that worked actively in the marketplace differently from what the trading desk might be able to do. Perhaps a good example of that would be Vale and Mosaic. When Vale came and had to dump their shares of Mosaic so that they could fund the rest of the mining operations, they did so via the capital markets, but probably the equity capital markets desk got involved. They probably called up Mosaic on behalf of Vale and said, hey, can you take down a huge chunk of this, and we'll try to disappear the rest via a secondary offering by calling up different big investment houses and seeing if they wanted a chunk at a discount. And just in case it's not clear, all of this is fee-based revenue based on volume of trades and transactions. Now, I would say that for this coming quarter, they might be able to beat an analyst estimate, but it would be shocking if they did remarkably well. On the debt side, you can have a look at my Upstart video, which clearly was showing that there was a difficulty in getting structured finance to actually care about the loans that they were trying to sell back into the marketplace. Now, the third area we're going to talk about is investment banking, and this one's probably the most straightforward of areas to describe. Investment banking division is really responsible for helping a company raise capital and capitalize itself. It's not going to be a simple loan that a single bank can take onto a balance sheet. Like, that would really be commercial banking. With investment banking, you're either going to need a lot of money via the debt markets, such that someone would need to share that risk across a lot of different investors. Alternatively, it might be an initial public offering of some sort. A third way might be what they call cap intro, which is a younger, smaller business that they're helping out to go raise initial private equity capital in a particular way. But it's always going to be about capitalizing a company in a non-traditional way. Non-traditional meaning the CEO, CFO, they're not going to walk into a bank and just get a loan. Now, investment banking makes money off of deal issuance, and deals get done best when markets are doing extremely well and interest rates are low. So realize, again, this is just financing cost. On the equity side of investment banking, the market, if it's doing really well, that means that people are willing to pay more for the equity of a company. When the markets are doing terribly, then usually the only thing that comes out is something that's somewhat distressed in nature. In other words, in the 2001 period, the insurance companies came out and issued secondary offering. I won't go through all the details, but essentially they really needed that money because their loss ratios were coming in far too high. Interest rates were doing a particular set of things, and they asked for money. And that ended up being some of the best secondary offering deals that you could have invested in. On the debt side of investment banking, that does really well when interest rates are low or they're rising, but not here. And what's really happened there is that interest rates, when they were low, that's easy financing for a lot of companies. With interest rates rising a little bit, then you've got a rush to refinance and lock in certain rates for long-term working capital or whatever it is that a company needs. With rates really high and companies not knowing whether rates are going to rise or fall, most of them are just going to take a big, gigantic pause and try to lower their capital structure first before going to the bankers. To see the investment banking deals get done, you will have to see the debt capital markets open up more fully. The last area of finance we're going to talk about is commercial banking. Commercial banking is your classic going to the teller, going to your local branch. It can also be online banking, though those are going to be significantly smaller players. But your classic commercial bank is going to make two types of income. The first is interest income, and for standalone commercial banks, that's going to be by far the largest. And the second type is going to be fee-based income. Your fee-based income is going to look a little bit like the asset management income I talked about and the investment banking income that I talked about. The interest income is really the component that's a little bit different. Interest income unambiguously improves as you have a rising rate environment. What they're doing is they're taking in your deposits, giving you a rate of return, usually close to nothing, and then they're lending it out farther down the yield curve. The only thing that can mess all of that up a little bit is if they somehow did not get rid of certain loans and they have to take a mark because the curve itself is doing something strange. There is a fancy sort of loss that you can take that's associated with the shiftiness of that curve. But in 2023, and given the manner in which most of the big banks are structured, it would be a little bit weird for them to have that particular problem. Most of the problems in duration are going to look more like Upstart, where they just can't get the loans off the books. And so as a result, that's really what we're going to be looking for this quarter. Now, as relates to interest income, that kind of has two little baby pieces to it. The first is whether or not they're giving you the right interest rate on your checking account. If that gets too high relative to the interest they can receive on loans, that's not great. But we can all check our checking account and realize that that's not happening. And that second piece is the nature and quality of that loan book that they're writing. And in this quarter, that is a big question mark for a lot of folks. So are they writing a bigger book of loans versus the ones that just rolled off and got paid off? What is the nature of those loans? What are the loss ratios that we expect to see in each bucket and vintage? The final thing I just want to talk about a little bit is costs. For pretty much all the large financial companies, there's really only a couple things that costs are. There's just not, this is not a capital intensive business in the sense that there's a bunch of factories or heavy equipment that you need. You will spend on technology and security and all the little subsets of data, et cetera. And that is very small relative to the total costs. Additionally, you might have rent expense, but these things are very small. And in many cases, a lot of the banks own their buildings. I mean, think about what they do. They give out mortgages. The piece that's by and large the most important piece is your labor cost. Now realize when times are good, it is really hard to find certain types of staff, particularly true in asset management and in investment banking. In asset management, good staff means people that have very rich clients that they're going to bring in more assets to the firm. In investment banking, it really is a particular set of skills with a particular client set that's attached to it that knows how to do a particular set of things. Usually in both of those businesses, you don't shed headcount until you're sure that you don't need it. Well, that's all I have for part one of this episode. If you enjoyed this and found this valuable, please do like, share, or comment below. If there are aspects of this that you want to clarify yourself because I said it unclearly, or if you'd like me to do further clarification on, stick it in the comments below. I'm always trying to brainstorm ideas for shows. So please do check out part two where I talk about what I pull out of bank earnings season. Additionally, I could always use a like, share, comment, or subscribe. You can click on this button to subscribe. Until next time, good luck in these markets.